technology. Current developments that raise policy issues include, first, digital asset exchanges. Some industry observers perceive digital asset trading platforms as functional equivalents to securities exchanges in buying and selling digital assets. But these platforms are not subject to SEC regulation, potentially making them less transparent and more susceptible to manipulation and fraud. Second, digital asset custody. Custodians provide safekeeping of financial assets. Digital assets present custody-related compliance challenges because custodians face difficulties in recording ownership, recovering lost assets, and providing audits, among other considerations. Third, digital asset ETFs. ETFs are pooled investment vehicles that gather and invest money from a variety of investors. ETF shares can trade on securities exchanges like a stock. The SEC has not yet approved any digital asset ETFs because of market manipulation and fraud concerns. Fourth, stablecoins. Stablecoin is a digital asset designed to maintain a stable value by linking its value to another asset or a basket of reserve assets, as seen in DM, formerly known as Libra, and Tether. In policy discussions, some suggest applying ETF regulatory frameworks to certain stablecoins. Others argue for more disclosure of the underlying reserve assets to expose potential deceptive activities. That concludes my testimony. I look forward to your questions. Thank you.
Thank you, Ms. Su. The chair now recognizes Ms. Goldstein. You are recognized for 5 minutes to give an oral presentation of your testimony.
Chairman Green, Ranking Member Emmer, and distinguished members of the subcommittee, thank you for inviting me to testify today. I'm the Director of Financial Policy at the Open Markets Institute, where my work focuses on financial regulation and consumer protection. Previously, I worked as a computer programmer at Morgan Stanley in electronic trading and at Merrill Lynch and Deutsche Bank as a business analyst serving the equity derivatives trading desks. Earlier this year, the blowup of a single family fund, Archegos Capital, led to $10 billion in bank losses after the firm's bets on about a dozen total return swaps imploded. Because these sorts of derivatives aren't currently reported to the Securities and Exchange Commission on Form 13F, banks and regulators alike were entirely in the dark about Archegos' positions until it blew up. The extent of hedge fund and family involvement in cryptocurrencies lives in a similar regulatory blind spot. Chairwoman Waters, to her credit, has introduced discussion draft legislation to try and address some of these concerns with Form 13F. And I believe that Congress and regulators should also consider requiring that hedge funds report their cryptocurrency positions on this form. If a majority of hedge funds with billions of dollars in assets under management begin to hold significant positions in crypto, as certain surveys indicate they are interested in doing, it may produce dire risks for financial systemic risk and may induce future crises, as volatile swings in the cryptocurrency markets could lead to things like forced liquidations on their assets. In addition to hedge funds, large too-big-to-fail banks and Silicon Valley venture capital firms are also a growing presence in crypto. VC firms have already invested $17 billion in crypto firms so far this year, which is more than 3 times what they invested in all of 2020. If you combine this with the fact that some cryptocurrencies have a majority of their supply held by a very small number of people, it raises concerns around concentration. To take one example, as of February, the top 20 largest Dogecoin addresses held half of the cryptocurrency's entire supply. There are also broad investor and consumer protection concerns in cryptocurrency that I have personally observed as a user of crypto exchanges and DeFi platforms. In traditional financial markets, barring a serious liquidity crisis, if you buy something, you can generally assume you can sell it back, especially with a stock. But on DeFi protocols like Uniswap and SushiSwap, anyone can upload a new cryptocurrency token, anyone can add a liquidity pool for it, including malicious actors who design tokens that can be bought but never sold. These so-called honeypot tokens are so prevalent that some DeFi protocols include an explicit warning about them on their website. Some crypto investors try to read the smart contracts or code of new coins to look for common pitfalls and avoid scams, but this is an extremely high bar for non-programmers. Some of the more concerning areas I've seen in DeFi are on platforms that offer derivatives. Frankly, it reminds me of the over-the-counter derivatives marketplace before Dodd-Frank, which I worked in as a banker in the late 2000s. Things like the US-based DYDX, Open, which offers options on cryptocurrency, and Ribbon Finance, which offers structured products based on crypto. Recently, CFTC Commissioner Dan Berkovitz said in his speech that unregistered DeFi exchanges may not be legal under the Commodity Exchange Act. I've also used a DeFi protocol called PancakeSwap, which often advertises very eye-popping annual percentage rates in exchange for locking a pair of cryptocurrencies into the platform's liquidity pools. APRs are probably not the right metric to attempt to use for what the crypto community called yield farming, as the rates can vary wildly even on a single day. But just to give you one example, in early May, PancakeSwap posted a tweet saying you could get a over 100,000% APR if you stake or locked in your Dogecoin on PancakeSwap. They later stated that that special rate was only there for 13 days, which is questionable to use for an APR. Users complained that the rate offered was nowhere near what they were advertising on Twitter, yet they tweeted again the same day that, quote, "The longer you wait, the less free money you get," end quote. I believe that Congress should continue to examine if there are regulatory gaps that require new legislation in order to ensure consumer and investor protection in crypto and avoid systemic risk. Regulators should continue to monitor the space and ensure compliance with existing laws. Thank you, and I look forward to your questions.
Thank you, Ms. Goldstein. The chair now recognizes Ms. Parker for 5 minutes to give an oral presentation of your testimony.
Thank you. Thank you, Chairman Green, Madam Chair Waters, Ranking Member Emmer, and members of the subcommittee for the opportunity to appear before you today. And thank you to the subcommittee staff for their hard work in putting together this hearing. My name is Christine Parker, and I'm a partner in the New York office of Reed Smith. I'm actually joined today by my colleague Trevor Levine, who was kind enough to brave the heat to come to DC with me. My practice focuses on regulatory enforcement and transactional matters related to commodities, derivatives, and digital assets. I routinely advise both regulated and unregulated digital asset market participants in connection with a number of different federal and state regulatory and prudential regimes. At the outset, I want to note that there are a lot of use cases for blockchain and digital ledger technology for which cryptocurrency serves as the fuel. I urge this subcommittee to engage with organizations that are working at the grassroots level to establish industry-sponsored voluntary self-regulatory associations for digital asset and crypto markets on both a global basis and at the national level, because I think there is a lot to be learned from them. I also want to point out that if we are going to innovate how we regulate these new markets, it really calls for a new kind of financial regulator. At a minimum, we need financial regulators that reflect the diversity of retail investors who are active or want to become active in the crypto markets. As advocates for responsible innovation, I don't think the crypto industry has been very good at pushing forward diverse voices, but we can and we should and we will do better on that front. However, we are here today to talk about the retail investors who are trading in the crypto markets. And I know there's been a lot of focus on the recent volatility in these markets. And what does that mean for Congress, for the regulators, and for retail investors? Just a quick point. The volatility in the crypto markets, I think, is not solely attributed to their lack of regulation. I will point out that crypto exchanges such as Gemini and Coinbase are not regulated like the Chicago Mercantile Exchange and the New York Stock Exchange, but they are regulated by the New York Department of Financial Services as limited purpose trust banks. They're subject to AML, KYC requirements as any other federal or state regulated bank. And they're subject to the Commodity Futures Trading Commission, the CFTC, has anti-fraud and anti-manipulation authority over the purchase and sale of Bitcoin and Ethereum on these trading markets and has actively used that authority in this space. Separately, volatility is not unique to the crypto markets. Last April, the crude oil market went negative. And in February, natural gas markets were incredibly volatile due to Winter Storm Uri. And there are products that are offered on CFTC regulated exchanges that are available to retail customers that are based on market volatility. So some investors are actually seeking out assets that are based on volatility on these very highly regulated exchanges. That being said, the question that we're really grappling with today is how do we best protect retail customers who are actively trading in the crypto markets? I think it's somewhat problematic to just sort of simply equate the crypto markets with terrorism, tax evaders, and bad actors. Realistically, every member of the subcommittee has a law-abiding constituent who enjoys trading crypto. So what is in the best interest of this constituent of yours who's trading crypto right now? Access to crypto markets that operate under a clear regulatory framework with both customer protection mandates and opportunities for risk that are commensurate with the suitability of the investor. Right now, we have an absurd patchwork of regulatory regimes at both the state and federal level. We have regulation by enforcement, interpretation, guidance, interpretive guidance, and public statements from regulators. One regulator says that a crypto asset is a currency, another says it is a security, and the outcome of that is incredibly harmful to retail customers. This lack of clarity stifles innovation in the US and frankly drives retail customers to foreign exchanges. So how do we better regulate cryptos? The CFTC and the SEC should be empowered by Congress to move quickly to provide retail investors with a broader array of regulated crypto products that are attractive to market participants, but come with the robust market oversight of these regulatory regimes. This should happen now. Congress should also direct the SEC to immediately create clear, workable criteria as to which digital assets are securities and therefore subject to US security laws and regulations. Second, while regulators in New York and Wyoming in particular have been very crypto-forward regulators and will continue to be leaders in this space, Congress needs to pass legislation to provide for the federal preemption of the current state-by-state licensing requirements for the direct purchase and sale of cryptocurrency. This will ensure that these transactions are subject to the level of market oversight that we currently have in the futures and securities markets. The logical regulator here is the CFTC, but you must ensure that you fully fund them so that they can take on this mandate. Thank you for the opportunity to speak today, and I look forward to your questions.
Thank you, Ms. Parker. Ms. Hammer, you are now recognized for 5 minutes to give an oral presentation of your testimony.
Chair Green, Ranking Member Emmer, and members of the subcommittee, thank you for the opportunity to testify today. My name is Sarah Hammer. I am Managing Director of the Stevens Center for Innovation and Finance and Senior Director of the Alternative Investments Program at the Wharton School of the University of Pennsylvania. I also oversee the blockchain laboratory within the Stevens Center at Wharton. Additionally, I am Adjunct Professor of Law at the University of Pennsylvania Law School, where I teach an upper-level Juris Doctor course on financial regulation. Before I proceed, I'd like to note that the views I express here today are my own and not the views of the Wharton School or the University of Pennsylvania. Blockchain is a shared immutable ledger that facilitates the recording of transactions in a network. Today, blockchain technology infiltrates and powers a myriad of institutions, functions, and assets in the United States and globally. The use cases for blockchain are too numerous to cover in detail here, but they include decentralized finance, enterprise blockchain, cybersecurity enhancements, and even addressing climate change. The subject of today's hearing is cryptocurrency. At the outset, it is worth noting that there is no official public data source for cryptocurrency prices, market size, or volatility. This lack of data is a significant problem. However, unofficial data sources have estimated that the total value of the cryptocurrency markets may exceed $2 trillion. Investors in cryptocurrency include retail, high net worth, and institutional investors, such as private funds, corporations, and endowments. Retail investment in cryptocurrency may give rise to particular concerns about investor protection, given the possibility of fraud or business failure, the lack of disclosure, and the high level of price volatility. The Securities Exchange Commission is charged with a tripartite mission of protecting investors, maintaining fair, orderly, and efficient markets, and facilitating capital formation. At the same time, the SEC faces challenges in applying capital markets and securities regulation to cryptocurrency. Chief among these is whether the SEC has the authority to regulate a particular instrument. Currently, the SEC evaluates crypto sales through the lens of a test known as the Howey test, which evaluates whether an instrument qualifies as an investment contract for the purposes of the Securities Act. While the SEC has applied securities regulation to dozens of initial coin offerings based on the Howey test, there is still a lack of clarity as to whether it applies to a number of crypto transactions that currently do not comply with SEC registration and disclosure obligations. In addition, a number of exchanges that offer trading in crypto, including those that meet the definition of a security, do not register with the SEC. Given this, there is a strong need to establish a clear, sufficient, and appropriate regulatory framework for cryptocurrency. I turn now to the issue of systemic risk. As discussed, the value of the cryptocurrency market is estimated to possibly exceed $2 trillion, and it is characterized by very high levels of price volatility. Additionally, estimates are that more than 2,000 different cryptocurrencies currently circulate globally. For context, estimates of subprime debt prior to the Great Financial Crisis are less than $1 trillion. Moreover, since no official data source exists for crypto markets, financial regulators are at a distinct disadvantage in evaluating their regulatory options. Because of the infiltration of crypto into so many institutions, functions, and assets, the potential risks must be carefully evaluated in a coordinated fashion. In light of the risks and considerations of crypto, a myriad of agencies, states, and international standard-setting bodies are implicated. Thus, a key question for regulation is, how should we proceed, and in what forum? Importantly, a government authority already exists that could support the development of a clear, sufficient, and appropriate framework for regulation of crypto. Established in 2010 by the Dodd-Frank Act, the Financial Stability Oversight Council is the appropriate forum to engage in evaluating and addressing potential systemic risks, convening and coordinating federal rulemaking on issues that touch multiple agency jurisdictions, and consulting with state and foreign regulatory authorities. I believe that by leveraging the authorities of the FSOC to support the development of a clear, sufficient, and appropriate framework for crypto, we can address concerns about fostering innovation, providing consistency, establishing global reach, and balancing our regulatory objectives. Thank you.
Thank you, Ms. Hammer. Mr. Van Volkenberg, you're now recognized for 5 minutes to give an oral presentation of your testimony.
Chairman Green, Ranking Member Emmer, members of the subcommittee. Thank you for the invitation to speak with you today. My name is Peter Van Valkenburg. I'm the Director of Research at Coin Center, which is an independent nonprofit that's focused on cryptocurrency public policy. The Bitcoin network has been processing transactions for longer than Uber has been offering rides. Bitcoin and other cryptocurrencies have enabled 3.1 billion transactions in the last 10 years, securing over $2 trillion in value. If cryptocurrencies were unregulated to this day, would that not be an incredible failure of our regulatory system? As I'll outline, it's not a failure because over the last 10 years, cryptocurrencies have been regulated. Some of that regulation, of course, does come from the technology itself. The scarcity of Bitcoin, a total supply of only 21 million, is not preserved by the goodwill and honesty of the participants on the network. It's secured by a transparent, peer-to-peer accounting technology, a public blockchain that makes fraud trivially cheap to detect and absurdly expensive to commit. But much regulation has also come from the federal and state governments. The on-ramps and off-ramps where people buy and sell Bitcoins for dollars and safekeep them are heavily regulated. They are state-licensed money transmitters, or else they are chartered banks and trust companies. Before offering any services to Americans, they must prove minimum capital requirements, post bonds, and open their doors to yearly examinations. They are also classified as financial institutions under the Bank Secrecy Act, They must register with FinCEN, know their customers, and share the details of suspicious activities with law enforcement. Cryptocurrencies like Bitcoin and Ethereum are commodities, but many crypto assets meet the flexible definition of an investment contract and are therefore securities, which means their issuance and their trading are regulated by the SEC. Cryptocurrency derivatives are regulated by the CFTC. Finally, anyone who markets a cryptocurrency service or tool that is deceptive or fraudulent is liable under various laws enforced by the CFPB, FTC, SEC, CFTC, and state attorneys general. And the results of all of this regulation speak for themselves. In 2020, only 0.34% of all cryptocurrency transaction volume involved a criminal sender or recipient. Despite several high-profile hacks of overseas exchanges, no American exchange has suffered a substantial hack or loss of consumer funds. Operators of money laundering exchanges overseas have been arrested. Sales of unregistered tokenized securities have been targeted by SEC enforcement, and criminal ransomware rings have had their servers seized and their ransoms recovered. All of this has happened by sensibly applying existing laws to the cryptocurrency space. We don't need new regulations. And all of this has also happened while preserving the fundamental value of cryptocurrencies as open access platforms for financial services and innovation. Unlike any other transactions technology that works online, an open blockchain network is accessible to people that banks and tech companies would rather ignore than serve. With the rise of central bank digital currencies from authoritarian nations happening in tandem with the rise of Bitcoin, we are at a decision point as an advanced technological society. Are we willing to accept some risks if it means we can eliminate the choke points to economic participation that further inequality and stifle innovation? Or would we prefer to strengthen those choke points and outlaw alternatives in the hopes that a powerful elite will smartly choose who should and should not have access to powerful tools and volatile markets? For every transaction that we want blocked, there is another transaction we should celebrate for being unstoppable. Yes, there are some criminals making payments on the Bitcoin network because banks won't bank them. There are also pro-democracy activists in Belarus and anti-police violence protesters in Nigeria taking donations on the Bitcoin network because local banks won't bank them. Nonprofits Bisol and Feminist Coalition in Nigeria raised millions of dollars in Bitcoin donations last year. Donations they were forbidden from accepting by a corrupt or otherwise uncaring banking sector in their respective countries. In America, we don't always agree, but no matter what, we are tolerant and expect everyone to have the opportunity to stand up and fight for their own vision of the good. Crypto innovation embodies that aspiration. It's rough around the edges, but holds some values above all. Every node is an equal. No one's voice should be censored, and work rather than privilege is what counts in consensus. Thank you.
Thank you, Mr. Van Valkenburg. The chair will now recognize the gentlewoman from California, the chair of the full committee, for 5 minutes for questions.
Thank you very much, Mr. Green. Ms. Goldstein, earlier this year, PricewaterhouseCoopers released their third annual survey of hedge funds in the cryptocurrency market. According to this survey, cryptocurrency currently accounts for 10 to 20% of all assets under management for 1 in 7 hedge funds. Over 60% of the hedge funds surveyed expressed a desire to start investing in cryptocurrencies or to accelerate their existing investments in cryptocurrencies by the end of 2021. Hedge funds often manage funds on behalf of mutual funds, pension plans, and other institutional investors, which affect millions of regular consumers and investors. Ms. Goldstein, do you see any systemic risks associated with hedge funds investing heavily in cryptocurrencies? And I'm more interested in this just having listened to the last presenter who talked about the choke point that we should not be so concerned about. What do you think?
Thank you, Chairwoman Waters, for the question. I'm very concerned about the presence of hedge funds in cryptocurrency. I think we've seen with the Archegos meltdown this year that when banks have prime broker relationships with hedge funds who are conducting, or family funds as Archegos was, who are doing risky things, it can redound to the taxpayer-backed financial system. Credit Suisse lost billions of dollars. All the banks lost some $10 billion. If hedge funds get farther into crypto, they don't care about direction. They'll go long, they'll go short, they can use leverage. There are lots of cryptocurrency exchanges like FTX and Binance and many others that allow people to use insane amounts of leverage, 100 times to 1. And hedge funds are the perfect client to use those sorts of leverage. So what happens if a huge number of hedge funds who have prime broker relationships with too big to fail banks all happen to be in similar crypto positions, whether it's long or short, and there's massive volatility in the market? They may have to sell some of their other assets. It may lead to margin calls in their non-crypto assets, which could lead to forced liquidations and sort of redound to the banks themselves in the form of counterparty risk. So
Let me ask you, are there any reporting requirements hedge funds must comply with that would provide regulators and the general public more transparency regarding which hedge funds are most heavily invested in cryptocurrencies and which of these institutional investor counterparties may also be exposed to potential risk?
Chairwoman, there are not, to my knowledge, because cryptocurrency is not currently reported on the Form 13F. It's not seen as an ownership interest. And so regulators are essentially totally in the dark about what hedge funds' cryptocurrency positions are, and I suppose have to rely on the financial press or trying to figure out based on the transactions on the blockchain and de-anonymize certain addresses and figure out who are the hedge funds. But there's no formalized way for regulators to know how much hedge funds are in crypto.
Ms. Hammer, you spoke to this issue somewhat. Would you give me your knowledge about what kind of oversight do we have now? What agencies have what responsibility, and what should we have?
Chair Waters, thank you for your question. I too have concerns about crypto trading by private funds. And one of the key issues, as I discussed in my opening statement, is transparency and the availability of data. In the crypto markets, we have no official public source for data. Investors are operating based on online websites. There are sometimes disparities over prices and interpretations of what volatility may be. And in some ways, it harkens back to credit default swaps prior to the great financial crisis. That was a market that was traded almost exclusively over the counter and highly unregulated. When the great financial crisis hit, we saw that credit default swaps exacerbated the risks. But once we regulated them and instituted central clearing counterparties, we had an official data source and an oversight regulator such that we could identify where the risks lay. I think the same is true for crypto. And as Ms. Goldstein said, the issues related to leverage and whether it's appropriate or not for some of these assets are extremely important. I do believe that at a high level, the authority of the FSOC to convene to coordinate the regulators is crucial, because we're talking not just about markets issues or private fund issues. We're talking about crypto within banks. We're talking about crypto within insurance companies and other non-banks, and that can implicate taxpayer dollars in a number of different ways. So in our system, the FSOC can convene to coordinate those authorities to work together.
Thank you very much. I yield back the balance of my time.
The gentlelady yields. The chair now recognizes the gentleman from Minnesota who has served on the FinCEN task force for 5 minutes.
Thank you, Mr. Chair. And this is interesting following on the testimony, the questions we just heard. Mr. Van Valkenburg, let's start with, this idea that there's a need for regulation. When people promise investors wild profits from proposed new digital tokens in an initial offering, is that regulated?
A promise of future profits reliant on the issuer's efforts is basically the Howey test. It's how we classify things as investment contracts. And so the SEC would probably treat those offerings in all cases as securities. They regulate issuance, and trading.
Well, let me keep going. I want to come back to that one because I want to talk about what the SEC would probably do and why that's a problem. When people make bets, again, Mr. Van Valkenburg, on the future price of cryptocurrencies or trade with leverage, as we've heard referenced, is that regulated?
So bets on the future price of an underlying commodity are swaps or futures. These are commodities derivatives, and the CFTC has jurisdiction over that kind of trade and those markets.
So yes, it's regulated.
Yes.
Can companies sell and transmit, and this probably goes to the first bit of testimony, can companies sell and transmit cryptocurrency without identifying their customers? Is that regulated?
That's heavily regulated, and while Representative Sherman said that the one advantage of this is avoiding KYC, I have to argue that every U.S. exchange is BSA regulated. They have to know their customers, file suspicious activity reports, and this has been the case since at least 2013.
So let me do the prices of cryptocurrencies like Dogecoin have been quite volatile and seemingly susceptible to influence by statements from persons and groups, maybe even manipulated, as was suggested by one of the opening statements here today. Is that regulated, Mr. Van Valkenburg?
So as an open source, open network cryptocurrency, Dogecoin likely does not qualify as a security. To the extent that that line is unclear, yourself, Congressman Emmer, have introduced excellent legislation last Congress that was bipartisan and co-sponsored by Soto and Khanna that would help clearly delineate that line between securities and commodities. But if we assume today that Dogecoin is a commodity, it is still a regulated commodity for various purposes. Specifically, in the manipulation context that you raised, the CFTC has the duty to investigate and prosecute manipulation, including at commodity spot markets under their CEA authority, Section 6C1, which Dodd-Frank added to the Commodities Exchange Act. As SEC Chairman Gensler recently testified, there is in some ways a gap here because unlike traditional commodity spot markets, which are like cattle auctions, I'm buying a commodity from you, you're selling it to me. These markets have much higher volumes and a lot more retail participation. So accordingly, it may be appropriate to extend market supervision to these entities. Another reasonable approach that I think would follow Chairman Gensler's recommendations is another piece of legislation that you introduced last Congress, the Digital Commodities Exchange Act. I'm sorry, Representative Conway, former Representative Conway introduced the legislation, but you co-sponsored it. And for that, we were grateful because it would create a reasonable guardrail-based approach to market supervision for places where people are trading these commodities, even at the spot market level.
Well, and I'd also introduce the Securities Clarity Act, which provides clarity for the SEC and token issues to swiftly determine when and if a token is a security. In the short time we have left, I believe that we do have the regulatory framework, the laws in place. People don't get to run in this country under the radar if they're complying with KYC and all the other regulations that are out there. Would you agree, Mr. Van Valkenburg, that the real issue here is, while we can do some work perhaps as Congress on the margins to clean up some of this, the real issue is the application of existing regulation and laws has not been consistent, and there has been little enforcement in terms of court decisions or things that can give us precedent so people in this area know what's right and what's wrong.
I think that's right. There's a certain wisdom to our flexible and open standards for investor protection in this country, like our securities laws that have these broad and flexible standards. However, they only work if controversies end up in court and judges make clear rules about new application of those laws. And one thing we've seen is a replacement of a lot of decisions made by judges, acknowledging the interests of the parties, with administrative guidance that is not always as clear as it could be. But the underlying laws are sound and should be applied.
Thank you.
The gentleman's time has expired. The chair recognizes the gentlewoman from North Carolina, Ms. Adams, for 5 minutes for your questions.
Thank you. Thank you, Chair Green, Ranking Member Emmer, and Chairwoman Waters for holding the hearing today. To our witnesses, thank you as well. Ms. Parker, there's a great deal of interest from both the public and from members of Congress with respect to the current regulatory framework overseeing crypto currencies. So as the vice chair of the Ag Committee, I've heard plenty of discussion from my colleagues about not only who should regulate cryptocurrencies, but how they should regulate these entities. So as you alluded to in your statement, many of these discussions have centered around the roles of the SEC and the CFTC. So how are cryptocurrency markets currently regulated in the U.S.? And is this level of oversight and regulation sufficient protection from the attendant risk posed? Parker.
Thank you. Thank you. That's an excellent question. And sort of like you, I come from the commodity side when I'm looking at these markets, and Bitcoin and ETH are the two tokens that we have a very clear regulatory framework. They're commodities. And so at the spot level, the cash level, the CFTC has generally not been active in that space in terms of sort of the robust market oversight that they provide to their futures exchanges. And that's just because of function of the commodity markets. They sort of arose from commercial entities coming together to buy and sell their, pork bellies and, orange juice concentrate and wheat and corn and soy. And so, those markets, we don't really have established trading spot markets for physical commodities or any form of commodities. So Bitcoin is sort of a novel application as an intangible physical commodity. It's sort of a novel application of these laws and these systems that have existed for almost 100 years. So what I would recommend, what I think makes sense, is that the CFTC is a very sort of robust and experienced market regulator. I think it makes sense to draw digital asset spot products. So I'm not talking about other physical commodities. I'm not talking about financial commodities, just digital asset spot commodities. I think it makes sense to pull them into the CFTC's market oversight framework and apply those sort of market conduct and market surveillance requirements that are imposed on the CME and ICE to these spot markets, because they.
Parker, I want to move on if I can. I'm trying to get another question, but thank you so much. So Ms. Sue, let me pivot to focusing on consumer protections. In my opinion, we've spent too much time over the past few years focusing on what happens on Twitter, but when it comes to cryptocurrency volatility, Twitter has been front and center. In January, we watched Bitcoin spike with each Elon Musk tweet. We watched it fluctuate in the months thereafter. So let me ask you, what are the most concerning risks to investors in cryptocurrency in the marketplace, and how can those risks be mitigated most effectively by regulators? Ms. Sue?
Yeah, thank you. I think from an investor protection perspective, if you look at capital markets related concern, there are three groups of primary risks we consider. Market volatility, as you highlighted, is definitely front and center, but the traditional way to handle it is through disclosure and investor restrictions. By that, we mean you provide material information about the risk, so investors would go into risk-taking in an informed way, so they would price the risk accurately. Similarly, with investor protection regarding restriction, it would be if you deem the instrument to be highly volatile and highly risk relative to the risk tolerance and the financial cushion certain individual investors have, you may exclude those investors from such investments.
Okay.
Other risks relating to like fraud and the scams, so obviously you handle it through rulemaking, enforcement, reporting, and then the third category, which people usually not paying particular attention, that is safekeeping functions like the lost password. I think you're probably generally aware, like 20% of certain digital asset was lost due to the lost key. So
Yes, ma'am.
safekeeping and custodian service
Th-
may remedy
Thank you,
that.
ma'am. Thank you very much. I'm out of time, and Mr. Chairman, I'm going to yield back.
The gentlelady's time has expired. The gentleman from Georgia, Mr. Loudermilk, is now recognized for 5 minutes.
Thank you, Mr. Chairman, and thanks to the panel for being here. It's a very important hearing we're having here today, and I think it's something we need to be looking at. But one of the aspects of being here is a lot of times people draw a line in the sand very early on, and they take an early position on something, especially when it's dealing with technology, because it's something either don't understand or there's this fear factor. And I've seen that with cryptocurrency because a lot of times we don't see the forest for the trees. And in this case, I think there's something that we miss out on because we have either decided we're for or against cryptocurrency. And that part we're missing out on is the blockchain technology that's underlining, which I think is very valuable for us in this nation, especially in the federal government. And I have been advocating for a long time that we utilize, or at least we look very strongly at using blockchain technology as a solution to our crypto, or not our crypto, but our cybersecurity issues here in this nation. When you consider the federal government, and we know that we've had cyber attacks, there's been loss of data, and people's personal data has been inadvertently disclosed, caused a lot of issues. That isn't that hard to do when you consider how many points my personal information and others' personal information reside within the federal government. I mean, there's duplication of data in every place that my social security number, my date of birth, my address, phone number, all of this resides is another a system that's susceptible to attack. And all it takes is one weak link. And then you've exposed it. I mean, if you look at it as a veteran, my information's at the VA. From years of working in business, it's been with various departments, Social Security Administration, you name it, IRS. You look at all the different databases. I did a count one time, there could be 47 different data points that just my information would reside. And all it takes is the breach of one of those. Because of the decentralization of blockchain, it seems to me that that may be the solution to the cybersecurity problems that we have in this nation. So, Ms. Hammer, is this something that you would agree with, and can you describe how the blockchain technology could be used to enhance cybersecurity?
Congressman, thank you for that excellent question. I appreciate the chance to talk about the potential benefits of blockchain technology. It's absolutely something that I would agree with, and certainly something that we work with on a day-to-day basis at the Stevens Center at Wharton. As you mentioned, blockchain is a decentralized technology, and that is key because it has no single point of failure. So there are many different uses for the technology, in addition to cryptocurrency. With each new block in blockchain, the previous blocks are stored, and this creates a fully traceable history log. So it can potentially have many cybersecurity applications. Blockchain can therefore be used to create security profiles for user data, such as you mentioned, and it protects the data by decentralizing it. In addition, blockchain technology incorporates something known as public key and private key security. So public key infrastructure, much like an email address, can be used to authenticate and authorize parties. And private keys can be combined with it for end-to-end security and encryption of our data. Blockchain can be used for many different means in cybersecurity. It can decentralize security devices, such as a home security system, to discourage hackers. It can protect websites by decentralizing domain name servers, such as separating an IP address from a name. And it can be, in fact, combined with other security protocols like biometrics in order to strengthen our cybersecurity options. So I fully agree there are many applications for blockchain technology, and it's important for us to remember this is the technology that powers crypto. But the technology itself also has many applications, and we behoove ourselves to consider those innovative possibilities.
And that's the challenge I've had, is separating what some would consider the stigma of cryptocurrency from blockchain. In the remaining time, I got one other question that if you could answer. Do you have concerns with a potential central bank digital currency?
Thank you, Congressman, for that excellent question. And I know that central bank digital currency has been the subject of other hearings in this forum. And certainly it's something that's being studied really across the country by many different academics and not-for-profits. I think it's important to consider that central bank digital currency could take many different forms. It could be blockchain powered, it could be not blockchain powered and run along a traditional database system such as we do currently. There are concerns about central bank digital currency. Some of them relate to issues around privacy and whether it actually achieves the objective of having a central bank digital currency, because rather than a decentralized system, which cryptocurrency is or blockchain is, having a central bank digital currency would concentrate our private information and therefore could potentially be a target for hackers. At the same time, I recognize there are
The
some...
gentleman's time has expired. Would you kindly give the rest of your answer in writing and submit it?
Absolutely. Thank you.
Thank you very much. And when I have my time, I may give her the opportunity to finish with my time. The gentlewoman from Georgia, Ms. Williams, the vice chair of the subcommittee, is now recognized for 5 minutes.
Thank you, Mr. Chairman. My top priority in Congress is ensuring that those most marginalized remain at the center of our policy considerations. When it comes to digital assets, this means making sure that investors of all experience levels have equitable access to information about the digital assets that they're investing in. Ms. Hammer, how can regulators best communicate with all consumers, especially those who may be investing for the first time, about any risk associated with investing in digital assets and ways to avoid predatory behavior in the market?
Congresswoman, thank you for that excellent question. And as I mentioned in my oral testimony, investor protection is a key concern and priority when we think about cryptocurrency. And I return to what I recommended in terms of coordinating federal agencies, because investor protection, consumer protection, and even ERISA and the Department of Labor are implicated when we think about investing in these markets. Not every investor is the same. Investors have different risk profiles, they have different periods of time that they can invest in, and not every asset is appropriate for every vehicle. Today, we're seeing cryptocurrency being introduced into things like retirement funds. We're seeing the rise of cryptocurrency amongst younger investors through different applications. And so I do feel strongly that, number one, coordination through the FSOC, through the federal financial agencies is extremely important, both from a consumer protection perspective and investor protection. And number two, that we have the data and the resources to evaluate what's happening in the market. Without an official public data source, I think that we're a little bit in the dark about what the proper regulatory framework should look like.
Thank you. It's important that we ensure consumer protection when it comes to digital assets, but we also have to be sure that we're protecting the health of the broader economy as the use of digital assets expands. So Ms. Hammer, more on this. Given that digital assets can change rapidly in value, are there legislative considerations that Congress should keep in mind to ensure any risk to the broader economy is minimized as investment expands in these assets?
Thank you, Congresswoman, for that question as well. And I do believe systemic risk is a key concern. I do believe that the Financial Stability Oversight Council is the proper authority to consider systemic risk under Section 120 of Dodd-Frank Act. It actually has a specific mandate to do so. The fact is that cryptocurrency has really infiltrated many different aspects of our financial system. And regardless of what we may think the benefits and costs of that may be, it is the reality today. Not only do investors hold crypto in their individual portfolios, but we see it in private funds, as Ms. Goldstein mentioned. We see it in banks. We have permitted banks to serve as custodians. We have national trust banks that are operating as crypto companies, and we have 50 different states that are looking at a myriad of crypto rules. I think at last count, 31 states were actually looking at crypto legislation in the current session. So this level of activity can be useful if it's innovative, but I think the key thing is that we have a race to the top. and not a race to the bottom. And there are some things that should be regulated on a federal level. As far as what a specific legislative mandate would look like, I think that's to be determined after substantive study by the FSOC, after we've established some public data sources and there's clear coordination amongst the agencies.
So knowing that we need more research and investigation around this, I'm thinking more in the lines of some of my priorities in Congress, which are ensuring consumer protection and the benefits to financial inclusion for more people. And so what are there any
There you got it. Be on the lookout for more regulation in the crypto space. As you can see, some of these regulators are looking to regulate this more. Not sure if it's going to be worse from what it currently is, or because of some regulation, some of these businesses actually just go offshore, but it looks like they're definitely looking for more regulation on different types of cryptos that are out there from existing ones too. So you'll probably see some of the cases, such as the Ripple one, being highly looked at, which it's currently already highly looked at, but from the point of view of these regulators here, it looks like it definitely is a security. If it's not, that would be quite interesting too. And then we also noticed that these DEXs are exchanges, basically. They're actually currently running as unregistered exchanges. As a couple of these people have mentioned already in here, they said there's a few DEXs that are unregistered exchanges. So keep that in mind with some of the DEXs that are out there. In the DeFi space too. DeFi space definitely are acting as exchanges, as you can see from some of these regulators' point of view and existing laws. So it's going to be quite interesting. Thanks a lot. Reshare this video, sign up, give me a like. I gotta bounce out of here, and this is becoming repetitive. What these people are saying right now, so I gotta turn off the video.